Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I'm joined, as always, by Cory Shepard. Glad you could be here, Cory.
Me too. I'm really excited for today. I think we need to let's not have that much fun at the beginning. Let's just dive in because I'm raring to go. This is a really exciting topic. People
Yeah,
might not think it is when they hear about it, but it is very exciting.
well, and to give a little context, we're going to be talking about these tools called index products. These are not index funds. These are index products sold mainly by insurance companies in the forms of annuities or life insurance, and it has to do with the underlying investment account. Now, here's the overriding issue and what brings this up today is that for most of you listening, here's the typical path an entrepreneur goes through or any high income person goes through. You go through time, you make more money, you end up with some surplus. And once you have some surplus, you kind of start looking around like, what could I do with this? And then somebody offers you a product.
Or the marketplace smells out your surplus. You start having people coming in, giving you calls. Right. Yeah.
Yep. And just like the song, I'm not going to sing it because I don't want to get stuck in your head, Baby Shark, these baby sharks show up and just chomp off a little bit of your wealth. Now, some of those things you drop money into will make you money. Some of them may cost you money over time. Here's the real issue. For most people listening, you have already spent most of your life in a cycle of building up assets, then like cash, and then finding a place to put it, or you received cash, inheritance, bonus, large K1 distribution from your company, and you find a place to put it. It could be a real estate deal, might be a financial product, it might be speculating in cryptocurrencies. But each time we do that, we're executing a tactic rather than taking time to sit back, look at the design that was put together for you being able to build a life that has definite financial independence so that you can fund a work optional lifestyle. It's not that. Instead of having that strategy that money gets deployed into, we just pick up another tactic along the road. And all the products that we see out in the marketplace, including this one, really depends on you stitching this in, not as a part of an overriding strategy, but as a tactic that you pick up with whatever amount of surplus you have.
Yeah, we're not going to tell you whether this product is good or bad because the reality is we can't. It has more to do with how it's put into the strategy of your life and how that plays out over time. So you're not going to hear this good, bad zealotry from us today that is really most people just take an opinion on one side or the other of this product is good or this is bad. But we'll give you a metaphor. Is water good or bad? Well,
depends.
Like water gives life. And if you go too many days without it, like not that many days without it, you're going to die. But not that much water applied in exactly the wrong place in your body is going to cause death. Like you can drown in just a couple tablespoons of water if it gets in the wrong place. So water is neither good nor bad. It all depends on how it is applied.
Yep, exactly. And here's what's attractive about these tools. These indexed products, or what used to be called equity indexed products, which you'll see why in a moment. The industry regulatory side pushed down on these companies, said you can't call it equity indexed anymore. You also see it as fixed indexed. But what it all comes down to is that underlying these, the way they're marketed, they appear like they're going to get equity rates of return. The most common index they're attached to is the Standard & Poor's 500. And while when you kind of look at it or you hear the sales pitch on these, it really seems like you're going to be able to achieve equity-like rates of return, say 7 to 9%. When in reality, they're only likely to slightly outperform fixed income rates of return if the company doesn't change the rules on you, and there are several ways that they can.
So, Paul, let's talk about, or let's rewind just a little bit for folks to really get them connected to what this means. Let's talk about how an equity index product works, which is one, it's connected to an index, say the S&P 500. But here's where we start to diverge from what people think and what's actually happening. Do they actually own any piece of what's in the S&P 500 index if they buy an index product?
Not even a little bit do they own the actual index. So let me give you a for instance. The index is this moving of numbers out in the marketplace. And what they're doing, now they are hedging against that index. They're doing things as the insurance company. Incidentally, these are exclusively sold by insurance companies. Almost all publicly traded companies whose fiduciary responsibility at the board level is to the stockholder, not a mutual company whose fiduciary responsibility is to the policyholder. Most of these products in the marketplace, and I mean like 90% of those sold, are being sold by stock companies. So that right there should tell you a little bit about maybe who the greatest benefactor is from the use of these products. Second, let's say we just picked anything else. The migration speed of Canadian geese. We could also tie it to that. Now, that wouldn't give the insurance company the ability to hedge it the same way. But in reality, it's just the movement of a number out there in the world somewhere that you do not own, that your returns that they're going to pay you are tied to. Now,
and no one can actually own an index. And they tell you that all the time. You can't actually own an index, but lots of mutual fund companies recreate the index by helping you buy all the individual stocks that are inside of that index. But you don't even own the individual stocks that are a part of the index or get things like dividends and all those other participations that you normally do by owning it. And that's
exactly
key.
where I wanted to go next, is that if you look at the Standard & Poor's 500 over the last like 40 years, depending on the year, 1.5% to 2% of the return of the Standard & Poor's 500 is the dividend paid by the companies in the Standard & Poor's 500. Except because you don't own the index and the insurance company is only paying you based upon the movement of the index in its points. So the point move in the index, it'll either be a 1 month move, a 1 year move. It doesn't matter because you don't own the dividend. So right there, we're losing return as compared to what we have in our head of what the S&P 500 returns. And then we're told in the marketing material, you're participating in the point move of the S&P 500 index. The insurance companies in the marketing material are being ethical in the way they speak it, but the way people collapse it in their minds is incomplete. Now, we also have something that limits how much of the return you get each year. Now, insurance companies do it in one of two ways. They either limit the participation rate in the performance of the index, which might look something like whatever the index gets in its point-to-point return each year, we will pay you, say, 70% of that. Now remember,
so if it goes up 100%, you only get 70%.
Yeah, exactly right. But remember, we also just lost about 2% a year to dividends. So if it was supposed to produce 11, you're already down to 9, and then you're only participating in 70% of the 9. Now the other way, and it's a little tricky the way they do it, in the marketing materials say your participation of 100% in the index is guaranteed, except they add a floor and a cap. So the floor says in any year you can't get less than 1% return. That's the floor. And then they'll have a cap, like you will never get higher than 9 or 7.5 on the index. Now, what you read when you read the illustration in the marketing material, you got to go a little deep to where they step down the font size a bit. It's going to tell you that they can change the cap rate, meaning that cap rate that maybe initially is marketed at 9 can actually be lowered as low as like 3. Now, why do they give themselves the ability to do that?
I was just asking, like, why do they do that? Is it because they think they'll never have to use it?
Well,
no.
And it's because regulatorily, they have to have that flexibility to change it in there because, as I understand it, it would produce statutory bankruptcy for all these companies if they actually said both the cap rate and participation rate are guaranteed, because the amount of hedging that they would have to do would absolutely diminish their reserves to a point at which the National Association of Insurance Commissioners would have a big problem with them and put them into some version of receivership. That having been said, I'm not saying any of these products are bad. We are just working to communicate to you why they can go not as well as perhaps the initial sales story sounds.
Well, it's just about expectations, right? If we're pointing to your most likely outcome is something a little bit better than fixed income returns, and that's the hole that you were looking to fill in your portfolio, then great. That could be a solution, right?
And consider that where these came out of, they've gained initial popularity after the tech bubble burst. People lost a lot of money in the market, and it falls under this like slot of planning called safe money strategies. Now that became even more popular after 2008, where people said, I don't want to be in the market, I don't want to lose money. And then the purveyor of these products hit the streets hard and said, we can save you. And at that time, they were called equity indexed annuities, equity indexed life. Now, the regulators have said you can't call it equity anything because it's too close to a security. So now it's just called fixed indexed or indexed life indexed annuities. But let's take a look at an actual company brochure that lays out how this works in a way that I think is pretty graphic and easy to understand.
And you're going to notice that we're not mentioning the name of the company. Their name is not anywhere on this. Please don't write in and ask which one it is. We're not going to tell you because we don't want it to be about any company like this. But if you do have an illustration that you're considering for one of these products, we'll be happy to review it with you. If you want to write in and ask us, we'll talk about that a little bit later.
Yep, indeed. So let's look at the Standard & Poor's 500 index. That's the blue line. And then the limitations of the cap and the floor are listed in orange. And what you can see is nearly every single year, the market goes up and down, but rarely does the Standard & Poor's 500 land in performance anywhere between the 7.5 or the 1.
It's usually above or below by a big margin.
Indeed. It's almost always above or below that band. And as a result of it being above or below that band, what we start to see is that, for starters, this goes through 2018. There aren't that many years that are even negative. In fact, let's just look at it. We have 1, 2, 3, 4, 5, and one that was almost zero. So I'll call it 6. 6 from 94 to 2018. That's 24 years. We only had 6 negative years. That means we had 18 positive years, most of which performed above the cap rate, and all that money was left on the table. Now, it doesn't mean that the insurance company owned the index and they made all that money. Nope, they're constantly hedging to make sure that they can keep the promise of being able to increase that. But if those hedges get really expensive, especially on the upside, say a big tear of a bull market, well, they may have to increase the cost it is to insure against the upside of the market via options, and may have to lower that cap rate. Now, this particular product is capped at 7.5%. We're going to look at that in a moment.
Right.
But go ahead.
One other thing, we don't want to go too far into it, but just want people to know that the point-to-point performance is based on the month that you start your policy, sometimes even the day that you go into that product. So that example is very unlikely that many people actually lived that specific example, because you could have 4 different people start the same exact product in 4 different months of 2019 and have very different performance over the next several years, because it's just month, year to year points, not based on when you start.
Yep,
the market
exactly
does a
right.
lot over a year.
Well, and that is so key, and that will affect every single year. So I'm going to say it a little bit differently, Cory. 4 different people could buy the same product on the first of each month, 4 months in a row, and have different performance over the next 10 years.
Yeah.
Now, I'm sure over a 20-year period of time, it would all even out, but over that initial window, you could actually get a different rate of return than somebody right next to you. So we're going to take a look. Again, I'm going to go to my screen, and we're going to look at how this compares when we use one of the programs that we, I think I figured out the other day, Cory, for all the different things we run for our clients, we are spending about $20,000 a year as a company, maybe a little more, just to give our clients access to the tools that could do these calculations. Yeah. So
I
what
know.
we're going to
We always talk about maybe we could pare that down a little bit, but for now, we got a lot of great tools. I agree.
well, as long as we still have to double check financial institutions and their
Yep.
marketing materials, or as an example, we review these kinds of contracts for our clients all the time. As a podcast listener, as Cory mentioned earlier, he's going to share with you later that if you think you have a product like this and you'd like it to be assessed, looked at, or at least give you a first blush of how that product works, we're going to just offer that to you as a podcast listener. That's not something we offer out in the marketplace to just do a tactical insurance policy review, but we're trying to bring more value to those of you that are taking the time, digging in and listening on a consistent basis to this podcast. You're doing something to pour into your financial future to help you design and build a good life. We just want to come alongside you and be of help. So we're going to take some of what we just talked about and say, well, how does this work? Well, here's our Standard & Poor's 500 total return. This includes dividends. And we're doing the exact same period from 1994 to 2018. And one of the first things I want to point out, let me see if I can go back to it quickly. Here is that first kind of good year was about, you can see it down here, 1995, 34%. That was the point return of the Standard & Poor's 500 index. Now, that was a good return that year, no question, but the return with the full participation in the index, including dividends, was 37.5. So you can see that year after year that we're missing out on that dividend can get super expensive in terms of the rate of return we're going to get. So total return 94 through 2018, actual return 10.68. That's average rate of return. We talked about that just recently on the podcast. Average return versus actual. The actual return of the index was 9.07, meaning if you put all your money in, how you get average rate of return is not by calculating all of the annual returns, adding them together, and then dividing by the number of years. That's getting you what's called the arithmetic mean average. This is what's called the geometric mean average. And if I had a chalkboard, I would look like some physicist from the 50s trying to write it out. I won't do that to you. But now what I want you to notice is, let's say we just introduce the floor and the cap on the total return. Here's what I want you to remember if you're listening just to the audio, and know that we're breaking these into clips on YouTube. So if you ever want to see the screen share, cut over to YouTube. Our team is chopping some of these into more bite-sized pieces so you can get that 5 minutes you were hoping to get. And this is going to be one of those clips.
Would you do me a favor first and just take the dividends out before anything else? I was curious.
Oh, yeah. So this is just the price movement.
We got the button on the bottom so we can see them both together.
Oh, I'm
sorry. If you go back to S&P 5.
Yep, hang on.
S&P
total return,
and then hit the dividends button. Yeah.
Look at that. Oh, yeah, we can put them right side by side. Now we drop from 9 to 6.96. Now, here's the big deal. That means $1 growth goes through, instead of $8.77, let me just multiply that bigger. Let's call that $8,770 versus $5,370. Or if it's millions, that's $8,770,000 versus $5,370,000. We haven't put the cap or the floor in yet. Now let's add the floor and the cap. And what we get is about a 5% rate of return, which means the 8.7 million instead is 3.4 million. That is a big difference. Now, keep in mind, yes, there's this drag that occurs from putting in the floor and the cap. Now, for some people, that might be what they need. They may be the kind of people that should consider just like a fixed annuity. And this has the potential to perform better than a fixed annuity if this is an annuity product. But here's the thing, when it's a life insurance policy, it's so different. If it's a life insurance policy, then along with this 5% rate of return, we still have mortality and expense charges coming out of it. So what some people would say right here, because periodically, every couple of years, Cory and I go back out to the marketplace and revisit our what we've learned and our assessments of what these products do.
You know, that's a good point, Paul, and I think a great time for us to take a quick break to hear a message from Sound Financial Group. So stay with us. We'll be right back.
Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to give you, get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show.
All right, and welcome back to our conversation around index products.
So we got on the phone with somebody who was super good in this equity index space late last year. And I mean, this person is responsible for millions and millions and millions of dollars of these products being sold every year. And when he's rolling through it with us, one of the things he's like, yeah, but it's tax-free inside the life insurance, to which we answered, yeah, but now it has mortality and expense charges coming out of it, which further lower that real rate of return. It's not uncommon at all that even if the company illustrates that policy at, say, 6.5%, once assessed over time, it actually ends up being like less than 4%. And it's because of the drag on the policy. Now, keep in mind that depends on how the policy is originally built. These life insurance policies that are equity index are almost always on a universal life chassis. So you have internal term insurance that's eating away at the returns.
And those costs go up over time because as you get older, that insurance cost gets higher. So it can kind of hit a spike in the 70s and 80s and really increase the cost.
Right when they illustrate, you're going to take out money. So again, this is something to be assessed. I would not recommend anybody cancel anything as a result of listening to this podcast. Make sure you're either engaging with us or some other competent professional to look through it.
On the fee, like what remind me, it's like maybe 1%, 2% on that. We can add some fees in there too, just to see what that would look like.
Most of the time, the annuity contracts are not going to have an extra fee of any sort.
Right. But on the life insurance side,
on the life insurance, if we just took like say 1% off every year for mortality and expense charges, you're going to end up with a product that returns about like whole life does. Right. As long as you're healthy and it's funded properly, et cetera. Except with the whole life, we don't have all this other variability up to and including the underlying cost of term insurance and this. Because if this company were to get into difficulty and couldn't maintain the 7.5% cap, they run into personal financial difficulty. They get bought by a hedge fund that just wants to make a bunch of money on the existing policies. Now we're dropping below 5% before any costs come out of the product. So for all those reasons, we need to be cautious. Now, lastly, and something I think you might be pointing to there, Cory, is that people will live with this like there's you can't lose money.
Right.
Now, I think there's the potential for that in the annuity contracts. Too often, these annuity contracts have really long surrender penalties. I would highly, highly, highly recommend that if you're considering something like this and it has anything longer than like a 5-year surrender charge, maybe 3, you really should get in touch with us or someone like us to have that double check. So it's not just the person affirming the sale, but somebody who can assess if this is the right kind of product for you, that the marketplace is being assessed for one of those tools that will work best for you. But let's say you put $100,000 over time, $10,000 a year over 10 years into an equity index life policy. And for some reason, either the market doesn't perform positively, they're not able to pay the interest, or they crash the cap down on you. Now, if those things happen in an annuity, you can exchange that annuity for another annuity with no taxes. If it happens inside a life insurance policy, what you're up against is insurability.
Yep.
You may not be as healthy as you were. So what can happen is, because of what Cory mentioned about the costs coming out of the contract, is over a 10-year period, you can lose money because the underlying mortality expense and term insurance costs inside that life insurance policy. Really important to know. All right. So we can jump off of my screen, Jordan. Man, I feel like I need to just take a breath, maybe breathe inside of a paper bag. We are working to keep our podcast a little tighter in terms of content. I hope that doesn't mean you needed to play Cory or I at half speed. But Cory, can you just tell them a little bit about our offer to help if they run into this?
Yeah. So, if you want to have some help assessing a policy like this, either one you already have or one you're considering, then send us an email to info@sfgway.com and attach whatever illustration, marketing material piece that you already have, or an illustration or report on your current product, and just put index in the subject line, and our team will reach out to you, have an initial call to see how we can best help you take a look at this. We don't need to spend a lot of time or have you commit to a lot of time, probably a 30-minute phone call just to talk about the considerations you might want to look at for that specific product. And then
no cost,
if there's more
Cory.
help, no cost.
No obligation. Just thank you for being a listener.
Yep.
Right on. Well, let's go back to where we started this podcast, where most of you are, that if you're in that $300,000 to $2 million a year income range, household income range, you've got surplus somewhere. And every time the surplus builds up, either because of your own reticular activator in the marketplace, you're looking for opportunities, or because, as Cory mentioned earlier, somehow the marketplace sniffs out you've got surplus and people begin to pitch tactics to you to take advantage of that surplus. Now, you would never do this in your business. You would never be like, well, we got some money in the bank, let's find a way to spend it. You would set strategy, your 3 to 5 year strategy. What do we want this business to look like? What markets are we going to be in? What does our employee base need to look like? What's our future organizational chart? And you make your investments based upon that strategy. We all do that in business. For some reason, it breaks down in our personal life. People literally make a new investment without a clear idea of their exact net worth, even before making the investment. How the investment's going to work. How do you exit in 3 to 5 or 10 years? What does that look like? Those are the things that we need laid into an overall financial strategy. Like, how much is enough? What's sufficiency? Do I want to shoot for surplus, or do I have a chance with my business to shoot for superfluence? And if I go for superfluence, 80-foot yacht money, and what I ought to be able to do is make sure I don't jeopardize my sufficiency or my surplus on the way to superfluence. So what we want for all of you today is just take away that if you've got surplus now and somebody comes and pitches you an idea or pitches you an investment strategy, but it doesn't entail the rest of your life strategy, then it's still a product. Somebody might be, I'm a fiduciary because I only take 1%, but they're still selling this product that they get a 1% management fee every year. That doesn't make it strategic.
Right.
That for you to design and build a good life, what you have to do is build the design first. And that's what we're here to help you with. For those of you that choose to participate in this offer of being able to get those index policies review, Cory or one of our team will circle back to you and offer you some targeted advice that I think is going to be incredibly valuable. And lastly, we want to encourage all of you, as you listen to this episode, think of a person that should hear this episode, a person that should take a listen to this podcast, because there's people to you close in your life that one day you're going to get older. And one day you're going to have financial sufficiency. If you're listening to this podcast, you're far more likely to have financial sufficiency, is my guess. Like if we had a disclosure on the screen, it would say, Paul just said that, don't take it to the bank. But what it does mean is that you are doing something to take better care of your finances. When you get older, you could be in a position that you look out to your friends and say, hey, we're celebrating. We're going on our first retirement trip. We're going to spend a month in Hawaii. We'd like you to go. And your friends go, what do you mean? Like you're able to retire? Make sure you share this with the people you care about, because without you, they may never find this podcast. And if they don't find this podcast or something like it, they may never have the chance to build their own financial sufficiency and be able to put them in a position that they get to stay in your life for the rest of your life, like age 65 to 95, where a lot of people aren't going to be able to. So with that, from Cory, from the team here at Sound Financial Group, from Your Business, Your Wealth, and the entire production team, and from me personally, we hope that this actual episode, this simple look at a product, was a contribution to you being able to design and build a good life. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.